March's Fed meeting is past us. And this is good news because the Fed surprised the markets with something they were not expecting. And what they did was kept the forecast for 2024 Fed rate cuts the same. So they're expecting 3 rate cuts by the end of 2024. The markets were expecting the Fed would dial that back and maybe only cut once or twice. On the long end of the curve, though, the Fed made a shift that we're not sure how to take this, and that is the longer end of the curve. So moving into 2025, 2026, the Fed is keeping rates higher for longer. In other words, they're reducing the number of rate cuts into the future while they kept the number of rate cuts in the forecast for 2024 the same. Time will tell how this affects the markets, because if the Fed keeps too much pressure on the markets, it could create fractures in the economy, resulting in a recession, which go back to our loans elevated market forecast. You can see a lot more information on this. If that happens, all bets are off and things could change dramatically. Also, the actions that they're taking and the pace of Fed rate cuts, so on and so forth, this can impact different markets differently. For example, stock market could behave differently than the real estate market and behave differently than the crypto market, so on and so forth. But there was one sneaky detail in Jerome Powell's comments after the meeting that could spell major success for the real estate market. Jerome Powell said, quote, "It will be appropriate to slow the pace of balance sheet reduction fairly soon," end quote. In other words, he's saying he could loosen up the financial conditions in the market without reducing the Fed funds rate, which is what most people are paying attention to. This is also known as quantitative tightening. What the Fed has been doing for nearly 2 years now is wiping out their holdings. So the Fed was, when rates were super low, the Fed was an unnatural, massive buyer of treasury bonds and what we care most about, mortgage bonds. And over the last couple of years, they've been an unnatural seller of these items, trying to reduce their balance sheet so they have more levers to pull. If the economy goes awry, they have the ability to increase their balance sheet and repurchase some of these assets, which really helped prop up the economy when it was crashing in the Great Recession. This unnatural selling that I'm speaking to is the Fed selling. Let's just speak about mortgage-backed securities, because that's the direct impact to the real estate market and mortgage rates. These mortgage-backed securities, they were outright selling these securities into the market and essentially flooding the markets with a supply of mortgage-backed securities on top of, most recently, a massive pullback in demand because mortgage-backed securities have been a big catalyst to the bank failures we've experienced and the pressure the banking world still faces today. Adding to the Fed selling their holdings of treasuries and mortgage-backed securities, which is the most important piece, we also saw the failed banks have to liquidate their holdings, which created even more supply hitting the market, which is why we saw rates spike even further late last year. As a result, we look at the simple supply and demand fundamentals of any market. If there is a market that is filled with too much supply and not enough demand, and in this case, shrinking demand because of other circumstances like the bank failures, the prices of those assets will go down to stoke increased demand. Well, as it works for mortgage rates, if the price of a mortgage-backed security goes down, the rate goes up. Think of it as a mortgage rate buy down, for example. If the price is at 100 and the price goes down to create more return on investment for the investors that want to buy this, in other words, stoke demand for this investment, well, let's say it goes down by 2% to 98. That means our buyers have to pay 2 points for the same rate they could have otherwise gotten with no points when it was previously priced at 100. So as the price goes down, the rate, in other words, goes up without a buy down. That's what we've been experiencing over the last couple of years and why rates have stayed so high. We care much more about the Fed stopping the selling of their mortgage-backed securities holdings than we care about them dropping Fed funds rates, because it has a direct and immediate impact, positive impact to the mortgage rates. This is something that could be a catalyst to an immediate 1% drop in mortgage rates, taking us closer to the historical spread between the 10-year Treasury and mortgage rates, which is way out of whack today. So I wanted to share this with you because it was a sneaky detail, not talked a lot about, starting to be talked about in our industry, but it's something that could spell massive success and create a sense of urgency for buyers to buy today, because when rates fall, this market becomes much more competitive, multi-offers ensue, bid over list price ensues, so on and so forth. Hope this is helpful. A little bit technical information. Thank you for tuning in. Please share this with anybody that you know that might find value in understanding the dynamics that we're facing and what to pay attention to so they can time their real estate investing properly.